Sector rotation and how traders can take advantage of it and catch markets before fundamental investors have a chance. I'm with Corey Rosenblum. Hi, Corey.
Hi, Greg.
Tell us about how technical analysis works with sector rotation, how you look at it, and what you've seen works.
Sure. And in terms of sector rotation, this is kind of teachings from Sam Stovall, Peter Navarro, and others that have discussed, and John Murphy even, and Martin Preen. So this is rooted in technical analysis of longer term moves. And if we discuss sector rotation, we're talking about economic cycles, and we divide the market out in terms of how we look on the charts to usually 9 different sectors. Won't go through them all, but essentially we're looking at technology, basically breaking into 2 different things: risk on, or the aggressive or the offensive side, retail, financials, technology, etc. And we're looking at the conservative or the defensive side, which would be healthcare, staples, and utilities. So if you break the market, the S&P, the Dow, into 2 different groups, those are the components, but it goes beyond that, and it has to do with the economic cycle. So at the beginning of an economic cycle, after a bear market or after a recession, or as a market or as the economy is finding a bottom, usually interest rates are low, and we have conditions. People have been saving, they have saved up money, and they've not been purchasing houses or cars or larger investments. Well, they begin to do that. The prices become cheap, and so they begin to reach out and to take those cheaper houses and cars, etc. So we start to see these things in the charts of certain stocks, home builders, for example, financial companies, as they are making more loans. Then, as the economy reflates and the cycle continues, we see companies repurchase or purchase new technologies, or reinvest, or they take replacements of their computers or their infrastructure. They begin to see technology shares rise in companies, infrastructure things. Then, and also consumer discretionary stocks, which would be home builders, and anything with the home gambling stocks, things like that. Things that people are taking
durable goods.
Right, durable goods, exactly. Yes. Retail. Then, as a cycle moves on, this is years that takes place, so the whole cycle, it begins to go to material goods, industrial goods, finally peaking with inflation, which inflation, as the economy recovers, does pick up too. Eventually, there becomes a point where inflation has gone too high. So we look for the final cycle in energy, which would be oil or gas prices, especially in terms of consumers, gas prices. Those get too high, people cut back, they stop spending, and as the markets are going too high, they're sometimes over leveraged. Lots of things happen, and in a short summary, the market begins to show signs of peaking, and investors begin to rotate towards the more risk-off assets. And so that's generally, in a very concise, quick manner, about sector rotation, but how it affects investors.
Well, where are we in that cycle?
Right now, I would say in terms of the later economic expansion, we are seeing inflation, we're seeing oil prices rise. We've been in a recovery since technically, I think June 2009. The stock market bottomed March 2009, so we had a little bit of a lead, and the financials were not the ones to lead the market. They've been underperformers. That's unusual. But what just happened? A financial crisis. So there's a little bit of an overriding factor. We have seen lots of performance or overperformance in retail. We've seen in technology. Yeah. We've seen commodities rise. We've seen lots of things go on over the last 3 years. This has happened. And we're probably towards the middle to late economic expansion. What we would be looking for a caution sign of potential danger would be energy, would be inflation. We're not quite seeing that yet, so things are still clear. Interest rates are record lows, they're very low, and inflation is by the chairman's stance, not that much of a problem. So we're looking at this. So we would be looking for risk on assets, or actually risk on aggressive style sectors. Again, technology. I would focus our attention on technology, materials, industrials, with the warning sign being energy. If we start to see any kind of strength on a longer term basis in these defensive names, healthcare, utilities, and consumer staples, like Clorox or things we purchase at all points in time. We don't always buy a house or buy a car or buy clothes. We'll always buy toothpaste. So this is what we look at. So this is how we segment it out and make our decisions.
Wonderful. Thank you.
Thank you.
And thank you for watching the MoneyShow.com video network.